Good morning. I'm Vince Lancy. This is the Gold Fix Market Rundown. We have two stories today to touch on. First, silver has broken through 60 yesterday and 61 last night for the first time as a multi-year supply deficit, surging industrial demand, tariff fears, and retail speculation, such as it is, collide into a full-scale, physical, slow-moving squeeze. Second, we want to talk about Russia. Russia may be preparing to pull a page from its palladium playbook over the years. And if it succeeds, a 2026 export ban will probably quietly remove a major source of global bullion supply, tightening physical markets just as BRICS nations reposition gold as a strategic collateral asset. But let's start with the markets. There's the homepage. We'll be talking about those stories. 10-year yields are unchanged bid. The dollar is down 12, almost 13. The S&P 500 is down 2.5 handles. NASDAQ is down 22. The VIX is up 45 basis points. Gold is down 10, 11. Silver is up 33. Copper is up 6. WTI is up 11. Natural gas is down 7. Bitcoin down 680. Ethereum unchanged, basically. Platinum, palladium both down 18 and down 27. I'm sorry, palladium and platinum both down 20, down 28 now. Gold, silver under 70, trading 68.75 right now. Soy, corn, and wheat down, down, and down, pretty equally with wheat taking a little bit more on the chin. Okay, so you're looking at that board and you're saying, what the hell's going on? Well, nothing happens in a straight line, but you're going to see it happening in fits and starts. So there are still people selling gold and buying silver. That's mechanical carry trades being unwound. Copper was bought. Maybe there's just not as much selling of copper yesterday. It did get a drubbing, and so there might be some value buyers, value shoppers out there. Today is Fed Day, and we'll discuss that in the context of silver's rally near the end of the program. First story, silver surged above 60 an ounce for the first time after more than doubling this year as years of undersupply met booming industrial and investor demand. Production remains constrained because most silver is mined as a byproduct, limiting supply response. Tariff concerns have driven stockpiling in the U.S., draining metal from other regions despite elevated COMEX inventories. With silver now labeled a U.S. critical mineral and possibly tariffs ahead, analysts say regional tightness is likely to persist. Now, if you hear that story from me and you say it doesn't sound like something Vince would say, well, that is not something I would say. It's all true, but it's all things that we know. That is my reading and breakdown strictly without putting an opinion on an FT post. That's an FT type of take on the silver market. The fact of the matter is the silver, now I'll give you the editorial comment. The silver that's going into the COMEX vault, not despite, because of that silver going into the COMEX vault. That silver is not leaving again. That's hoarding. And China's silver, they were emptying it, and now it's refilling. So despite silver going into China, no, it's because silver going into China. London is being triaged, and they're fighting for their lives right now. So there's plenty of silver, to put it in their terminology, but it's not where it's supposed to be. And so it's not getting pushed, it's getting pulled, and that makes prices go up. That's demand, and we have a big shortfall. There's more to it than that, but that's it for now. That continues in the post. We did not email that yet. We sent another one out. That continues in the post. Silver breaks 61 on London lease rate rise. Now, the London lease rate rise part, that's us. FT's not talking about that. Bloomberg's not talking about that. We are. And one of our founders had a nice chart for us to include, and that's in the premium section of that report. So enjoy. Silver's up because lease rates are going up again. Next, this is where the puck's going to be. Russia is proposing a 2026 ban on exporting refined gold bars, building on its existing scrap export restrictions from last year, designed to curb capital flight and retain strategic resources. No decree is finalized, but officials confirm the policy direction. If enacted, Russian mine output would be redirected towards domestic reserves and collateral channels instead of global markets. When combined with similar supply retention actions across China and Asia, the move echoes Moscow's early 2000s palladium squeeze and points towards higher global physical bullion availability ahead, or tighter global physical bullion availability ahead. Now, what we did was, as soon as we saw that they were, here's the bottom line. Last year, they said we're going to restrict scrap gold from being sent out. And they also, in the past 6 months, stopped selling their own central bank gold publicly. And they stopped doing that. That's an important sign. We covered that in detail. That was a breakdown of a SocGen analysis. And we covered that in detail, noting that for the last 2 years since the war had started, for the last 2.5 years since the war had started, Ukraine war, Russia would circumvent sanctions by selling its gold to a former Soviet country, Armenia, Kazakhstan, and Uzbekistan, I think, or Azerbaijan. I'm not sure, but one of those. I have those three countries somewhere. One of the stands, and those countries would then liquidate it in London. So you had selling coming from Russia to satellite countries, and those satellite countries were liquidated. So that's the workaround, right? It's like the oil thing that India is doing. And that was consistent with financing the war. However, this year, they've stopped doing that. So is that because they don't have any more gold? No. Is that because they don't need any more money? Well, maybe they need less money, or maybe they have China giving it to them for the gold straight up. I'll tell you what it probably has to do with. The BRICS are collateralizing gold. And every nation that's important in the BRICS is telling their people to buy gold. China, have a gold savings account. Russia is now telling its people to buy gold. Russia owns gold through its people as well. And India, their people already own all the gold that they can own, I think. Now they're trying to get them to buy more silver. So the point is, Russia, here's the key part you're not going to get anywhere else. Okay? We lived through the palladium squeeze, mostly as witnesses, but again, very instrumental in our education and how good of a trader Putin is. Putin squeezes palladium. He squeezed it to death in 1999, 2001. He made Ford lock in $1 billion loss on their own palladium risk, which is ridiculous. And they've done it in natural gas from time to time to Europe over the decades. So we highly recommend that if you're interested in where the puck's going to be, if you give Russia a chance, they're going to not squeeze. You can't squeeze gold. They're going to make people in the West cry uncle and raise their floor and buy gold a little bit more aggressively. Anyway, it's a full explanation of what they did and how they did it going back in 1999 and 2000 and their policy since then. As a student of markets, that was important to me to learn. Okay. Next story. We sent this out this morning. ECB warns Italy to reconsider gold recall. Out of Frankfurt, the European Central Bank has renewed its request for Italy to reconsider proposed legislation declaring the nation's gold reserves the property of its citizens, warning the measure could interfere with the central bank's operational independence and potentially open a door to political influence over bullion holdings. Okay, bullshit. And we said it was bullshit the moment we saw the very first Reuters blurb on it. It's bullshit. And I'll say it again here for you. When the ECB realized that they needed to make sure they could centralize the FX behavior and gold activity of the other central banks, it passed, this is post-Brexit, it passed a ruling or a law or some sort of a whatever they call those things, idea that they restricted all the other central banks in Europe's ability to buy, sell, or hedge gold and buy, sell, or hedge currencies more than a certain amount. Now, in doing that, they were centralizing gold, which is not a bad idea if you're going to make your economy one economy. Now, I'm not saying I would do that, but I'm saying that's what you would do in that position, and you just got over a Brexit crisis. And by the way, this was all part of Basel III. They had to get all this done before Basel III. And so most of the central banks outside of the US keep their gold in their central bank, theoretically, or probably actually. And so the central bank has the gold. Now the European Central Bank says, we control the gold. It's your gold. We're not saying it's not your gold, but we control it. You can't buy or sell it unless we say X, Y, and Z. And now Italy is saying, no, that's our gold. And in case you're not sure of it, we're going to literally take it back on our balance sheet from our own central bank. So our gold is not in your pooled gold that you're using. Why is this extremely significant? Extremely significant. Because after Brexit, just like the IMF does, the ECB went around to countries with central banks like Italy and said, your liability to us is X amount of dollars or X amount of euros, whatever they use. So we're going to put a collateral claim on X amount of gold that you have. And so what you'll find out, and this is a hat tip to Scott, a founder, that if you look at the liabilities that Italy has to the ECB for whatever their debt is, well, you're going to find out that the liabilities to the ECB match the gold controlled by the ECB. So what is Italy doing? Italy's saying, you can't use our gold for collateral anymore. It's our gold. That was voluntary, and we're not volunteering it anymore. So the autonomy of the Italian central bank is horseshit. It's about centralizing control of gold in Europe. If these guys don't get their shit together fiscally, get a united fiscal policy, Europe's done. It's already done with the other stuff going on there. Anyway, so Italy is like, the new Germany, ironically, right? Okay, so those are the stories, and there's the other stories. There's a lot of news coming out, so we have to cover that. And that, in case you missed it, TD's Golly says silver squeeze is done, platinum pump next. That may be delayed, but certainly something worth reading. And going into the day, today's Fed day. Okay, so starting with Fed day and working backwards. If you're a trader, Fed day is 2 trading sessions, before 2 p.m. and after 2 p.m. Look at it as 2 days. So what's happening before is not necessarily what's going to happen after. What's happening before won't continue after. What's happening before won't necessarily reverse after. What's happening before is different from what's happening after. The Fed is expected to cut 25 basis points. Yesterday was a day where the markets in general decreased their expectations of further cuts. Zero Hedge reported that, or noted that anyway, I should say. And but silver went up. So that just tells you silver is not about economics right now. It's the economics of silver that matter. So how does this relate to yesterday's behavior in markets? Silver was the easiest one to see. See, silver, I'll start last night during Asian hours, 2 nights ago, and then bring it around to right now. So Sunday night, Asia opened. I'm sorry, Monday night. Monday night, Asia opened and sold. And that was Shanghai speculators and CTAs getting short or selling. At 4 a.m., when London was deep, Shanghai bought silver, physical silver. So that translated into the rally that we saw in the US when it ran into ETF buying. So you got ETF buying, Shanghai selling, and Shanghai buying during London. Last night, right, with silver on the highs, you got Shanghai buying, which is why silver went up. And you've got London. I don't know what happened in London. I don't really have a good feel for that at 4 a.m. But now you're running into US ETF buying. So what are you looking at? You're looking at people, you're running into 3 time zones, and all 3 time zones have a reason to buy. And if 2 of them buy at the same time, we go up. So here we are, above $61. It is not, look, I love saying silver squeeze, just like the next guy. It is not a short squeeze. You have no idea what a short squeeze is. I've never been in a real bona fide short squeeze. I mean, I've been in it, but it only lasted for 5 minutes. The London short squeeze, where the LME, London Metal Exchange, nickel, doubles or triples inside of a couple days, that's a capitulation. A short squeeze ends with a capitulation. So far, there's no capitulation. There's a comfort in rolling. And that's reflected in the lease rates. Lease rates were spiking, they went down, and now they're going like this now. So the whole floor on lease rates is being raised. And so I think, God willing, there won't be a short squeeze. There will be a chronic, painful backwardation, like what happened in palladium in the O's and 20s. Constant pain for people who don't want to default, but don't have the metal. And I'm Vince. Have a great day. Oh, wait, I'll just put this up to give you a chart. Oh yeah, I should focus on this a little bit for the technical guys in the chat. Okay, think of it this way. Whatever your technical chart method is, that's fine. But think of this. Yesterday, here's the run up at 10 a.m., right? So that's the trend day higher starting. And when it gets above 60, first time up to 60, well, I was looking at a 15-minute chart when this was going down. The 15-minute chart, it kept hitting 60 and bouncing down and coming off, and then it pierced it, searched for selling. There was no selling, maybe a little bit of selling, and then it took off again. This buying here, I promise you that buying is hot money. That's Fed money. That's FOMC money. That's momentum money. Oh, it's above 60. Let's buy some. That's CTA money. This is physical. This is physical demand. This is physical demand coming home to roost. This is CTA money. And this is oh, so there you go. We did have selling. We had selling out of London at 3 a.m. Okay, so that means Shanghai didn't buy. Shanghai physical didn't buy. So now you have Shanghai futures traders, all the guys that sold on the other night, they're covering shorts now. And then in London, you had no activity by China, and now you have ETF demand coming in. So the market's got a mind of its own right now. How do you look at that? Well, I would say if the FOMC comes out and it's bearish for silver, we can go back to $60. I don't give a shit, right? If it's bullish for silver, I have no idea, but you can go to wherever it goes. It's going to be ETF buying that comes in. It'll be American ETF buying and more CTA buying. If the only thing I'm worried about is if the Fed cut is a hawkish cut, the rhetoric that comes out of it, then you could see the market crack 60. 60 is important to me because if it hits 60 from all those guys, those idiots puking, let them puke. If there's real physical buying there again, that means the floor is ratcheting up and the physical guys are getting more and more nervous. And it'll be a perpetual short squeeze. See you later.